This is the Alhambra Investments Global Asset Allocation Update. This is February of 2019, and let me put a picture of Joe up there on the screen too. Hey, Joe.
Hey, Bob. How you doing?
I'm doing good. Hey, it's been, I think November 19th was the last time that you did an allocation update, and a lot of that had to do with the fact that nothing was changing, but then we hit the fourth quarter, and there were some things that caused you to make some changes this time around. 20% correction in the fourth quarter.
Yeah, most of it in December. It was a big month, and I didn't write an asset allocation update in December. I did write a kind of a review and outlook piece that came out the first week of January that kind of substituted for that. But I felt like we needed to when we made some minor changes to our bond portfolio in early January, but it didn't seem like it warranted some big long commentary on my part, so we kind of put that off. But I think it's probably time we let everybody know what's going on.
We sat at 50% risk assets and 50% bonds for a long, long time. You've shifted now, and we're 50% risk, 10% cash, and 40% bonds. We've seen the market start to come back in January and February of this year. So in a lot of ways, nothing has changed. If you looked at where we were in November, where we are right now, pretty much the same place.
No, it's that Rip Van Winkle effect. If you fell asleep in November and you woke up today, you'd say, well, what's everybody all upset about? Because nothing's really changed all that much. I would say on the risk allocation, by the way, we are shifting that a little bit. It was, as you said, 50, 40, and 10. We're reducing that cash a little bit in this asset allocation update. So, but we are going to be that 50% risk assets or 55% risk assets in the new allocation. Look, I said at 50-50 for a very long time because it just didn't seem like there was a whole lot going in either direction. The economy's growing at 2%. We had that short period, that short burst of activity after the Trump election, but otherwise things just really haven't changed all that much. I didn't see much reason to change things, but the correction in the fourth quarter, I think, did give us some insight, I think, as to where the potential is in this market. And I think that we can make some changes here. I'm not going to go wild here and buy a bunch of things, but there are some interesting underlying things that allow us to get back to our strategic allocation, particularly on real assets. And I think it was a good opportunity to do that, and I took it.
Well, talk about what we're doing tactically to get back to that strategic allocation. I think that's important.
Well, by being essentially underweight risk assets. Where were we underweight? We were underweight everything on the risk side. We were underweight stocks, real estate, and commodities. And so we had been overweight bonds. We took that excess that we took out of the risk side, we put it in the bond side. It had some impact on returns. It was probably held us back a little bit because stocks did perform pretty well there for a couple of years. But we just didn't feel like there was a lot of, the risk reward wasn't great, put it that way. So what I wanted to do was to shift back towards our strategic allocation. The strategic allocation that we talk about in these updates is the moderate allocation, and that's essentially a 60-40 portfolio. It's 60% in risk assets, it's 40% in bonds. Now, our strategic allocation, and we've talked about this before, strategy and tactics. Strategy and strategic allocation is the long-term plan to get us to where we want to go. The tactics are shorter-term things that we use to implement that strategic plan. So the strategic plan calls for a roughly 60-40 split. And what we do that's unique, I think, is how we split up to 60 on the risk side. Most people in our business, that 60 is all stocks. We don't think that's diversified enough. So we do stocks, real estate, and commodities, and we have a much bigger allocation to real estate than most people do. But we had been underweight the real asset side of the portfolio for a long time, even going back further than the 50-50 split on risk versus bonds. And we did that because the dollar's been fairly strong, and we know we're not going to get as much out of real assets in that situation or in that environment that we would in a weak dollar environment. So this is this allocation change now is to get us up to a normal weight on real estate, a normal weight on commodities. We're still going to be a little underweight on equities and a normal weight on bonds. We've got a small cash reserve. So I think the question and the thing we're going to talk about today is, why did we do that? Why did we get those real assets back up to where they would be in the strategic allocation?
Well, you mentioned commodities, so let's talk about that for a minute because we're seeing some interesting things in commodities. Long term, we're seeing a buy signal on commodities, but long term on stocks, we're seeing a sell signal.
Yeah, look, we follow momentum. Momentum is part of our methodology, what we do on the tactical side. We watch momentum pretty closely, but we watch it on different time scales. And, we're not traders, so what happens on a daily chart, a short-term chart, really doesn't matter to us all that much. Weekly starts to get interesting, and where we really, really get interested is in the long term on the monthly charts, where we're looking at price and volume data going back years. And so we have some momentum indicators that we use, and the one for the S&P 500, just to take that as an example, we just recently received at the end of December a sell signal from this long-term momentum indicator that we use, and it's one of the very few that we ever get with this indicator, which is why I pay attention to it. Just to give you some why we pay attention. Well, it triggered in 1999, late 99, and said you should sell. Well, it turned out to be a pretty good timing. It also did the same thing in November of 2007, which was about as close to the top as you could possibly get. It did so again in 2015 before the last correction in 2016. That one wasn't as great because you didn't get a huge bear market, but it still was a timely signal. It flipped back to buy, and now we've just gotten another sell signal on this momentum indicator that we use. So since 1999, or since the late 90s, you had 1999, 2007, 2015, and now. That's only four in roughly 20 years, four sell signals in 20 years. Look, I think that's something you ought to pay attention to. So we are going to remain underweight stocks. The flip side of that is commodity indexes and the commodity and individual commodities too, but mostly we watch the commodity indexes. Those commodity indexes have been going down all this time. So the momentum has been negative the entire time since the crisis in 2008. And I mean, some brief interludes where things popped up, but basically it's been down since then. Well, those momentum indicators now are turning positive. And we also look at relative changes. So we look at a ratio chart between, say, commodities and the S&P 500. So we want to know when commodities are starting to outperform stocks on a relative basis. That's starting to happen too. So look, it's just an acknowledgement that momentum is shifting. We don't know why. We're not making any predictions about why. We don't know if it's going to last, but it is what it is. Momentum is shifting. We have to acknowledge it.
The dollar plays a part in that too, and I know you looked at that because the dollar's been doing some gyrations here lately. But we've also seen we expected more action in Europe, and that just didn't happen.
Look, the dollar has been remarkably stable, actually. I mean, look, you got a pop in the dollar after Trump was elected. People got optimistic, but we sold off, went down to 85 on the dollar index. But really, if you think about it, the dollar hasn't changed all that much over the last few years. I mean, it's oscillated, but really we're kind of back where we were. The thing that's intriguing here is that we've had this firming up of commodity prices without seeing a fall in the dollar, which is what we would normally expect. And so we're beginning to think that maybe the commodities are starting to lead the dollar index, so that the commodities are the canary in the coal mine. And if commodities continue to rally, we suspect the dollar will follow and go down. Look, there's a lot of reasons, and Jeff and I have talked about this a lot. Jeff still believes that there is a shortage out there of dollars outside the United States. I think he is right to some degree. He still believes that we will see the dollar firm to higher and get another deflationary episode. I'm not so sure about that. Jeff and I debate endlessly. We don't always agree. But we do debate every day. And so right now we are not exactly on the same page. But look, I'm following the market and saying, look, this is what the momentum is telling us. I'm sure that if that follows through, the fundamental data will follow and Jeff will get on board. But we'll have to see how it falls out. He may end up being right. Maybe he's right. Maybe we do get that deflationary episode. But I've said all along, since Trump was elected, I think this is political. Ultimately, the Trump administration favors a cheaper dollar, and administrations usually get the dollar they want.
The changes we made, we raised gold to 6.5% from 5%. We raised general commodity allocations to 6% from 5%. Added 2.5% to CUT, the timber REIT, and
Right.
that was interesting to me. And then the cash position we dropped 5% to 5% from 10%.
Yeah. Well, the timber position, timber is an asset diversifier, an asset class diversifier that I really love. Timber returns are not correlated to stocks, are not correlated to commodities. They're barely correlated to real estate. So they're just an odd duck kind of asset class, but they provide cash flow. They are a real asset, obviously. And we're kind of acknowledging here too, listen, my family has owned timberland for a very long time. So I know a little bit about the industry, certainly not as much as some of my relatives, but I know a little bit about it. And I will tell you that there were a ton of people that went in and bought timberland, particularly in the South, over the last few decades, thinking it was this, as my uncle used to say, that's my retirement plan. You know, the back 40 back there that's planted in hardwood, that's my retirement plan. And there's a lot of people in the South that did exactly the same thing. Problem with that is so many people did it, there's a glut. And so, look, it's that old saying about you got to buy when there's blood in the streets. Well, there's not exactly blood in the streets, but there's a lot of excess timber out there. Prices are not that great. Point is that those things have turned higher. The timber REITs have turned higher. Timber prices have probably turned higher too, and so we'll follow through with that. I just like it as a non-correlated asset. It's not going to move with the stock market. It will somewhat move with interest rates and somewhat with the housing market, obviously, but it's just kind of an odd duck, and it's a great diversifier.
So with all the things we've talked about, if you look at the markets right now, long term, anything specific that you think they're telling us?
Well, the commodity markets seem to be saying that economic growth is going to pick up, but we don't see that in the other markets. There's a lot of conflicting things here. I guess what I would say is what I said in the piece, which is not a lot's changed. Look, we have been, I don't know how many times we come on here and say that, the economy hasn't changed, but it hasn't. We're still growing at 2%. It just keeps doing what it's doing. And all of that is reflected in all the other things that we follow, whether we're talking about real interest rates or nominal interest rates or commodity indexes, all these things, just not that much has changed. Look, if this commodity thing follows through, that could be a big deal. If the commodity prices continue to firm, it's an inflationary signal, especially if the dollar starts to fall too. Look, there's no change right now. There's no big changes right now, but we could be seeing the beginning of a big change. Something I've thought about a lot is this idea that we are going through a secular shift to higher inflation and higher interest rates. I think eventually that has to happen. I don't think we're headed for Japan territory where rates go to zero and stay there. So it could be a big deal. This turn up in commodities could be a big deal, but it's not yet.